Tuesday, February 8th, 2022, Monaco 64, home of alternative economics and contrarian views. So today we're going to look at commodity shortages and backwardation. You might not have heard of backwardation, but we're going to go through it today and how it could be a harbinger or a canary in the coal mine trying to tell us of a possible currency crisis. And a currency crisis would be, of course, the dollar crisis, a fiat currency crisis. It would involve the whole world, not just the dollar, seeing the dollar is a major, well, the major reserve currency of the world. Before I start though, I like to say I did a video yesterday entitled Carbon Neutrality is Aggravating Energy and Cost of Living Crisis. I spoke about a topic that YouTube doesn't like too much, questioning the climate change agenda. And I got a lot of comment from people. I usually am not notified of all the videos you do every day, and I didn't get notified of this one. Well, it's called shadow banning. And just for those of you who are new to the channel, I make a video every day. So the best way for you to go watch this video is go on my homepage on YouTube and click on videos, not on the home itself. Go on home and then click on videos, because it gives you all my videos in order. And you will see that is the last video I did before this one, of course. And you will notice that I probably have 50% less, even more views than the average videos that I do. So why are we talking about commodity shortages? Isn't it because of all the supply chain problems, all the lockdowns? Partly, but I think it's getting a little bit long in the tooth, that excuse. I think we've had enough time to settle that problem. And I think some analysts, especially Jeff Currie from Goldman Sachs, he's perplexed. You can watch this short interview he did with Bloomberg TV, and you'll see he's like, he doesn't know what to say. And I'm going to put a link to it below in the description. The story says Goldman commodity veteran says he's never seen a market like it. So Jeff Currie, the closely followed head of commodities research at Goldman Sachs Group, Inc., says he's never seen commodity markets pricing in the shortages they are right now. And he says, I've been doing this 30 years and I've never seen markets like this. Currie said in a Bloomberg TV interview. And he said as well, this is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, aluminium, or aluminum, as Americans would say it. You name it, we're out of it. And I've noticed as well, there is some backwardation, because that's what it means, the shortages, and I'm going to come to that in a minute. Some of you might be thinking, what in the world is backwardation? It's also happening to agricultural commodities. So I will not go through the rest of this article. You can do it. I'm going to put a link to it in the description under. But what I'm going to do is go back to one of my favorite articles I read many, many years ago. And I was reminded of Professor Fekete, Antal Fekete. I hope I'm pronouncing that right. I think he was a Canadian of Hungarian descent. He died a couple of years ago. He was a mathematician. He was a monetary historian. And he ran what was called a new Austrian school of economics. He didn't really agree with a lot of things from the traditional Austrian school, but that's beside the point. And one of the viewers reminded me through Patreon that Rafi Faber did an interview with Keith Weiner, I think that's his name, from Monetary Metals, I think last week. And Keith Weiner was a big follower, or is a big follower of Professor Fekete. He passed on in 2020, Professor Fekete, but I used to follow him a lot back in the day when I was still in the city of London. One of my colleagues who got him into gold and sound money, he found Professor Fekete, and we used to read a lot of his stuff. And he's written a really great piece here back in 2013, and it's entitled "My Crusade to Fend Off Permanent Gold Backwardation." It's not a long article. It's only about 10 pages, maybe 11, and you can go through the whole thing. I read it again yesterday, and I'm going to go through some parts of it to try to explain what's going on and what I think Jeff Currie doesn't understand, that it's not just a molecule crisis. I think it's a currency crisis as well. But a lot of the mainstream economists, analysts like Jeff Currie and others, they probably never heard of Professor Antal Fekete. They never really bother to look into the Austrian school. So they don't know what's going on, in my opinion. He goes on to talk about how Keynes really got it all wrong in terms of backwardation, but that's beside the point. But what about gold backwardation? What does that mean? Well, let's see what Professor Fekete says. The threat of permanent gold backwardation is one that, in my view, casts a dark shadow on the future of our civilization, much the same way as the disappearance of gold from commerce cast one in 476 AD, the year when the western half of the Roman Empire collapsed, world trade succumbed to barter, law and order broke down, and centuries of dark age descended upon Western Europe. So I'm going to stop right here. Just to clarify, there is no backwardation right now in the gold curve, futures curve, cash and futures curve. There might be a slight backwardation in silver, but it's mostly in the other commodities. And we have seen backwardation in gold and silver before, just to clarify. He says, for this reason, the subject should be treated responsibly and with the humility it deserves. So the rest is something he had kind of an argument with another analyst. I'm not going to go through that. But here he explains futures markets, which is very interesting. So he says, there are three broad explanations justifying the existence of futures markets. And why futures markets? Well, because we're talking about commodities, gold and silver, and other futures as well. So the first explanation to justify the existence of futures market is insurance offered to producers and consumers to cover the risk of extreme price swings. Number two, outlet for human gambling instincts, whereby gamblers can place their bets on the course of future price movements in the hope of large leverage gains. Number three, warehousing, market for warehousing services. So to, basically store the commodities. And he goes on about Keynes. I'm not going to go through this. Suffice it to say, Keynes was wrong about backwardation. He thought markets were always in backwardation, but as Professor Fekete explains, markets are normally in Contango. And what is Contango? Well, it's when the price of a commodity in the future is higher than the spot price or the cash price that you can buy now. And why is that? Well, because it costs to store the commodity in the future, so the price is higher. There's the cost of financing that you have to add to it as well, interest rate. So markets are normally in contango and not backwardation. So what is backwardation? Well, backwardation is when people want the commodity desperately. There's a shortage and they'll pay more for now than they will for in the future. But let's continue. The second explanation appears a notch more serious. It would be hard to deny the fact that the commodity futures markets, no less than the equity markets, attract speculators like a honeypot attracts the bees. It may also be that speculation is the necessary catalyst to provide liquidity without which these markets could not function. Having said that, we must admit that there is a clear difference between organized commodity exchanges on the one hand and the casino or futures markets dealing in financial futures on the other. And I agree totally with him there, even though I did work in the financial futures market. Let's go on about what he thinks of financial futures and why it's really an anomaly historically. He says the difference is this: the risks involved in the former are created by nature in the commodities markets. By contrast, risks involved in the latter are artificial in that they are created by men, as in the case of the casino that rigs the chances to win at the roulette wheel or at the blackjack table, or by the government that discards the gold anchor in the monetary system and the gold leash in the fiscal system to create artificial risks where none existed before in the foreign exchange market and the bond market. Risks are rigged in favor of the casino or the government and to the prejudice of every other participant. Of course, the government keeps pretending mendaciously that such risks as exist are inherent in the foreign exchange and bond market. They are natural, and bad government cannot be blamed for the economic damage and human suffering they routinely cause. And this is the important part here in terms of the fiat currency system that I wanted to get to. He says, the fact remains, however, that futures markets for foreign exchange or for bonds were conspicuous only by their absence under the gold standard, not that they were outlawed. You could start one anytime of your choice, but variations in foreign exchange rates and in bond prices were so minuscule under the gold standard that speculation simply would not pay. One thing I would say, as it pertains to what Jeff Currie is saying now, he's perplexed. He's never seen this for 30 years that he's been around in the markets. And it's like backwardation all around in commodities, and they seem to be almost permanent. What Professor Fekete explains is that agricultural commodities, they do go into backwardation, and it's usually before the harvest because there's a bit of a shortage there, but eventually they go back into contango. And the other commodities like energy and base metals, they do go into backwardation, but their cycles are not as cyclical as commodities. But what he says about backwardation in commodities, that usually it doesn't last, because what it means is that the warehouses are getting empty and the prices for commodities now become higher than the prices in the future. So what people do, people who have the commodity, they will sell now and buy in the future. and lock in the gain, sort of an arbitrage. So that's why backwardation doesn't last forever. But the fact that it is doing so right now is a bad sign. So yes, according to Professor Fekete, the most important backwardation in terms of the currency system that we need to worry about. And as I said before, there is no backwardation at the moment in the gold futures curve. So let's go through what he says here about gold and futures trading. Gold futures trading has only a brief history of about 40 years. Don't forget, this was written in 2013. It was totally unknown under the gold standard. It started in the early 1970s at the Winnipeg Commodity Exchange in Canada, Manitoba province, when the ban on Americans to own and trade monetary gold was still in force. In 1975, the ban was lifted and trading gold futures shifted to COMEX in New York. A mystery in the gold futures markets soon presented itself. The gold basis, initially as robust as it can be, bumping against the carrying charge, started weakening gradually over the decades. So what is the basis? Well, it's the difference between the price, the cash price or spot price, and the future price. And that never really goes above the warehousing cost. That's the basis, and it's usually higher, of course. It's in Contango. Nobody could explain the phenomenon. It cost the chief economist of COMEX his job. By now, the gold basis has become so rickety that the gold futures market indecisively vacillates between contango and backwardation. Some people conjecture that the gold basis will ultimately settle down for a cyclical pattern like the basis for soft commodities, even though these so-called observers never fail to add that you can't eat gold. No deeper analysis was offered or sought. For the past 12 years, so this is since the beginning of the century, I would say, I have in my talks and articles spread the word that far from being cyclical, the gold basis exhibits a clear vanishing pattern. Moreover, it will necessarily culminate in permanent gold backwardation in the fullness of time. In suggesting this, I am fully alive to the fact that permanent backwardation is not possible for any other commodity futures market because the persistently falling basis is going to bring out fresh supplies sooner or later. So yeah, what I explained earlier, if there's backwardation or the basis narrows, people who have the commodity, they will sell it to buy it in the future and lock in a profit. The solution to the mystery, well, that's the vanishing basis or backwardation in gold, is found in the fact that gold is no ordinary commodity. It is a monetary metal. It fails to obey the law of supply and demand. Rising prices may fail to bring out fresh supplies. Quite the contrary, it may make the existing supply disappear altogether. There is impeccable logic behind this prognostication. In any futures market, basis dropping to zero and showing a tendency to dip into negative territory or backwardation is an incontrovertible sign of an increasing shortage of deliverable material. That has been the case for gold too for the past couple of years. The signs are all around us. Central banks first limited, then suspended their gold dumping campaign. The brave ones among them even started buying gold in open defiance of the wrath of the US Treasury. Right now, there's a run to exchange paper gold for physicals. China leads the pack with her unlimited appetite for ever more gold. The only exception is the Western democracies where the worshipping of the paper Moloch has been the strongest. There is no obvious source where the monetary gold will come from to feed the backwardation monster. Gold in Fort Knox is heavily hypothecated through multiple leasing arrangements. When the last registered gold bar leaves the warehouse, COMEX will become insolvent and a massive default on its gold futures contracts will follow. Interesting that he talks about the warehouse becoming emptier on COMEX. There's a guy here, as you can see, he follows that, how COMEX gold and silver supplies or registered supplies are falling. It matters little that they will call it by some other fancy name, such as liquidation only policy, standstill agreement, cash settlement preference, or any other that comes to mind. Default is default by whatever name it goes. As I have repeatedly said, the threat of permanent gold backwardation is a most serious one. It threatens all of us, regardless whether we participate in gold futures trading or we don't. It is incumbent on the government to fend it off at all hazards, just as it should take preventive measures in the case of the Grand Kool-Aid Dam was about to give way. Nevertheless, my warnings have fallen upon deaf ears. Ben Bernanke has on occasion even boasted that he does not understand gold. It sounds to this observer that the captain of the boat is boasting that he does not know the first thing about navigation. But why must one see the disappearance of gold as a sign of public danger? Well, the COMEX default will be no ordinary default. It will be cataclysmic. It will, for the first time, reveal that the U.S. Treasury paper or bonds is not only irredeemable, but it is outright worthless. Right now, you could still get some gold for it, however little. To the extent you could, the dollar is still a monetary instrument. In fact, one of the most potent. After the onset of permanent gold backwardation, it will cease to be that. The dollar will fetch no more gold, not one grain, from one day to the next. That will be the day when Ben Bernanke or his successor or successors on the way to Damascus will come to see the light. They will come to understand gold. That will be the day when all banks in the Western world will become insolvent. Bank reserves held in the form of U.S. Treasury paper will go up in a puff of smoke. Franklin Delano Roosevelt took the insane advice of Judas Iscariot Keynes to make the dollar irredeemable domestically in 1933. Richard Nixon took the evil advice of Milton Mephistopheles, that's Milton Friedman, to make the dollar irredeemable internationally, i.e. declare it the ultimate extinguisher of debt in 1971. Neither measure, however forceful, was sufficient to administer the coup de grace to the dollar. All respectable monetary scientists were most incredulous at the time. They had all been predicting that the dollar, once made irredeemable, was ready to succumb to the sudden death syndrome. Well, it didn't. Their failure to appreciate the fact that you could still buy gold with dollars cost these upright scientists their credibility. Everybody became convinced that the dollar was invincible. The rear guard of the gold standard was ridiculed as a bunch of superstitious old foggy bottoms. Today, I find myself in the minority of one in suggesting that the dollar will not collapse as long as it can still buy some gold. Everybody believes the day will never dawn when the dollar can no longer buy even 1 grain of gold. just like everybody believes that the day will never dawn when the sun fails to rise. Why? It is a contradiction in terms. Yet such a day that the dollar won't fetch 1 grain of gold is going to dawn. And you won't have to wait for it till doomsday. It is around the corner. I leave the challenge to debate the semantics of the word arbitrage unanswered. I will continue my crusade trying to fend off permanent gold backwardation. The American government could do it overnight by opening the US Mint to gold. It is not too late to do it. I continue to sound the alarm that the present insane gold policy of our political and economic leadership shall land us in the black hole of permanent gold backwardation, with a ticket to the next dark age of Western civilization. So there you go. What does he mean by opening the US Mint to gold? Well, it means that anyone with any gold, be it jewelry or gold that you find, panning for gold or whatever, can go to the US Mint and ask them to mint a coin, a gold coin, a 10-piece, a 5-piece dollar gold coin, according to the Coinage Act, of course. Because that's how the money supply should be created, not by the Federal Reserve, not fiat currency. So, yes, we're not close to gold backwardation right now, nor silver for that matter, even though there has been a little bit of backwardation there. But the important thing is that we shouldn't see permanent backwardation in other commodities. And this could be a bad sign. It could mean that eventually we're going to start seeing the same for gold. And when that happens, of course, yeah, that will be a very dangerous situation. I don't think people in government or in central banking are listening or have listened to what Professor Fekete is warning about. But I think it will start in the case of gold when the price starts rising and the demand for gold starts increasing for physical gold and silver. That's when the backwardation will start. It's not going to be the other way around, I think. So, yeah, a lot of people are going to think, well, gold is going to go up. There's going to be more supply. No, but it's going to be a fear of holding fiat currency. Yeah, and it's a very dangerous situation. And it's not a situation that I like to see the world in. And it's why I've been trying to warn people about fiat currency and why sound money is so important. But it's gone unheard, of course. People haven't listened. There are a few politicians out there who know about this, but they're a tiny minority. So I've gone on longer than usual, but be as it may, let's quickly look at the markets this morning. It's 9:10 a.m. London time. So we've got spot or cash gold at 18.18. It's down about $2. A high has been 18.2350 and the low 18.15. Silver is down about 13 cents at 22.86. High has been 23.06. The low 22.76. Dow futures is up 100 points. NASDAQ is up 25 and the S&P is up 11. FTSE is up 30. So stock market's a little firmer this morning. The fiat currencies, pound is unchanged, 135.40. The euro coming off a little bit here after a big run up in the last week. We're down 1/3%, just above 114. The dollar is up 0.2 versus the yen, 115.33. The dollar is up 0.2 versus the Chinese yuan at 637.25. The Aussie dollar is unchanged, 71.28. The dollar is up 1/8 versus the Canadian dollar, 126.83. And the Kiwi dollar is unchanged, 66.36. General commodities, WTI crude is down 0.2% at 89.69. High-grade copper is down 1.2% at 441. U.S. nat gas is up almost 1% at 425. And to finish off the bond market, and the bond market is showing some signals that things are changing. The supply or the abundance of credit is being reined in. That's what bond investors seem to think. The 10-year yield is making a high for the year here. Overnight, we went up to 196. Right now, we're at 194, 1.94% up, 2.5 basis points. I've noticed as well that the Japanese government bond 10-year yield is made a 6-year high. It's only at 0.21%, but it's very significant that it's moving higher. We're seeing yields in Italy and places like Greece pick up a bit, and also in the UK. We're seeing everywhere the bond yields are going higher and bond prices are going lower. That's not a good sign for the overall health of the financial system and the economy for that matter. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.